Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Julian Scurci with us. And Julian, it's great to have you. I am kind of fascinated by your whole trip from New Jersey to Denver to the West Coast. You're now in Palo Alto. So give us a little hint as to how that all happened.
Well, first of all, Bruce, thank you for having me. Pleasure to be on your show. I really enjoy the learning opportunity and to learn from you and to the rest of the real estate community. Yeah, I wish I told you I had some master plan to move west, and it was about manifest destiny. It was mostly I made choices for reasons of school, the heart, or work, and I eventually met a California girl, have California wife, California kids. So I think my wife's never lived more than 30 miles from Pacific Ocean, so I'm here for the foreseeable future. But yes, I'm a New Jersey refugee. I've been off the East Coast for almost 17 years. I had about 7 years in Denver, Colorado, between grad school at University of Denver and work. And I've been in the Bay Area, about 12 years now, either in SF or in the South Bay with young children. But it's been a great place. I've been fortunate to live in many different parts of the country, and been great to build a network and do business all around the U.S. But I definitely appreciate the Bay Area for the reasons that most of us do. How intellectually curious it is, how cosmopolitan. I think the intersection of technology, entrepreneurship, innovation, it being a capital center for many different industries. I find that all that really candidly inspiring. It's just a fun place to do business and to raise children in.
Oh yeah, no, it's a great place. Our kids are a little older, but yeah, we had a fantastic time raising our kids here. So tell us a little bit about your business.
Yeah, thank you. I've been now in the commercial real estate industry not quite 20 years. Again, I didn't have some master plan. I was in business school during the last real estate bubble, pre-GFC, and candidly, that's where they were handing out all the jobs. So that's how I fell into commercial real estate. I'm a finance nerd. I was fortunate. I actually went to business school in Colorado mostly because I have a younger sister I'm close with, and she was like, "Hey, you can go to grad school and ski a lot." And I was like, "That sounds like a good idea." So that was part of my journey there. But the interesting thing about Colorado is they have, because of some state laws, a lot of the REIT industry is headquartered there. So I was fortunate enough to get a job out of business school at Prologis, which at the time was the largest landowner in the world, and the largest industrial REIT. And it was a great place to cut my teeth. I was in the investment management group. I worked in the fund management for basically a mutual fund of industrial real estate assets. I had a front row seat to the end of the world during the financial crisis, where we were partnered with Lehman Brothers. As being younger in your career, to go through something like that and see, what candidly the challenges of leverage and the dangers of leverage, as well as what happens when you stay too long at the party, and being imprudent with risk taking. And it was really informative. I think that informed the rest of my career as a value investor and as someone who thinks about risk and mispricing of risk. It was much better to go through that early in my career than later on, seeing people who are executives or bosses of mine, really having having real impactful negative events on their life in their careers, with children in college. It just makes you think about how you assess risk and think about risk. So really, for the bulk of my career, I've been either in asset management, acquisitions, and my career morphed over time as more friends left REIT and REIT world and started private equity funds, where I would join in a partnership capacity, mostly for the capital raising side, still getting a chance to do lots of acquisitions. So I spend most of my time doing value add, opportunistic, distressed investing, some structured credit investing, preferred equity, in pretty much every commercial asset class, but with a bias towards industrial, where I started my career, office and multifamily. I've always dealt in existing assets. I really don't have a lot of ground up development experience.
Mm.
I've never done anything in raw land or horizontal development or residential. And then, I've had this fun adjacency, I would say the last, 8 years where I've done some brokerage work, mostly on the capital markets side, and really doing, I would say, being a rainmaker for different brokerage shops where I have licenses or interests in different states on behalf of clients, mostly for, buyer representation or investment sales, helping people with 1031s. Living in the Bay Area, as you appreciate, you're in your third grade dad's fantasy football league, and you're the only real estate guy surrounded by tech or venture people. And they want to sell properties, or they want to sell some Google stock, and they want to reinvest it and redeploy it into real estate. So I've had fun helping friends with those kind of investment opportunities. Same with business owners, whether it be finding office space or buying office buildings for them to utilize for their workforce, or doing some fun strategic advising on expansion plans. But yeah, I feel very fortunate. I've been able to, work in various aspects of the industry. I think we live in a very interesting time cycle wise right now. And I get to, ironically, I live in the Bay Area for personal reasons, but I get to do work all around the country. And I've had a wonderful time, meeting, people in our industry. And, I'm constantly trying to learn more and constantly trying to do things that are intellectually stimulating as well.
Well, so as you say, we are in an interesting time right now. And so are you seeing, obviously, there's some fire sales out there, and the banks don't want the properties back. So, if you have cash and can hold on for a while, there's some interesting values out there. What are you seeing?
Yeah, I think that's a great point. I mean, I'm obviously talking my book here to a certain extent, so please push back and stress test my assumptions. The the only way I know how to make money in real estate investing is to buy a dollar for less than a dollar. And I'm a very cash flow centric investor. I think a lot about asymmetry of risk reward. How do you get equity like returns when you're buying things cheap, and really get a real calculated risk on that, a real margin of safety too. And right now, I think it's really one of the best buying opportunities in real estate that I've seen in my career, really since the financial crisis, because finally you have big catalysts out of the ZIRP era. You're no longer in an artificially low interest rate environment.
Right.
But for such a credit intensive asset class and debt intensive asset class like real estate, where you have these debt triggers for shorter term loans for commercial properties, where the maturity is now coming due, and these properties were purchased at much higher valuations. The math just doesn't math. The capital stack. There's nothing. When people talk about distressed properties, a lot of times it's not the property that's distressed; it's the ownership structure. And
Right.
what I find, look, I wish ill on no one, and I'm not, a predatory person, but what I think about, when you look about opportunistic investing, when you see the kind of big fat pitches you have right now, where you can buy fundamentally sound assets below replacement costs because the debt is coming due and candidly the equity is wiped out from the current owner. If you can, if you're someone with capital or wants to redeploy capital into real estate, I think you're finally, for the first time in at least 7 or 8 years, getting paid the kind of returns that you would look for the illiquidity premium of an asset class. So I'm really excited about the next 3 to 5 years in real estate because I think volatility breeds opportunity. I think it's going to be, there's going to be a lot of turmoil in every aspect of the business, and there's going to be a lot of properties that are forced to change hands. And I think, as a value investor, that should excite you. And also, candidly for brokers too, for all the, I think lamenting of, oh, it's, tougher to be a broker, volatility creates a lot of opportunity for, price discovery, for changes in ownership, for changes in leasing activity. And I think, that's what I'm focused on right now is the volatility, because I think, that's going to be really the driver for the next few years.
Okay, so let's see if we can break this down a little bit into the different classes. Let's take the office world to start, since that's the most volatile right now, at least in my opinion.
Yeah, I
So
mean,
there,
yeah, I would think so. Like, here's a great example, and you can tease me away, but I've done up until this really past couple class really 18 months, I had not been doing much work in the Bay Area or California for that matter at all, just because the prices weren't they weren't there was better yields and other opportunities on a relative basis in different states. Not a political comment, but I spent a lot of my career taking money and capital out of high cost, more regulated environments into better business environments that are more welcoming to capital, where you can get better returns. So, but right now, like I just was part of a, big effort to buy a downtown San Francisco office building for about 20 cents on the dollar. And that was a big fat pitch in my opinion, and I think that's a real theme. And I think distressed office in general right now is a theme. I'm not with this, I'm not with the camp that we're all going to be in remote work, and you might be in a you might have some, you might not necessarily go back to the pre-COVID times of those kind of occupancy levels, but you haven't had any new construction in office in a number of years. You can buy things for pennies on the dollar. And when I look at San Francisco, just focusing on that right now, I mean, our whole theory of the case is my wife works in venture world.
mm,
She's all the VC capital that's flowing into the AI companies. It's really a derivative of the AI investment boom, which you can, where that goes and how bubblicious that is remains to be seen. But when you have a real spigot of capital funding smaller startup companies, and all these companies and entrepreneurs want to be in San Francisco, I feel very comfortable buying buildings below replacement costs where I'm seeing leasing velocity pick up. I'm seeing, people return to office, and, it's not, I think we finally have good political leadership in San Francisco for the first time in a while. It's
right.
more pragmatic. It's more, open for business. You have, really solved the crime issue to a larger extent too. I like that trade. I like the trade that you can get assets cheap while rents are rising, occupancy is rising, and eventually, I think you sell to institutional investors. But I think that's not just an SF. The dynamic for AI companies might be SF specific, but there's going to be cheap opportunities in office, I think, for a number of years because the asset class became so out of favor. So that's a theme that I like a lot for the next few years.
So okay, let's step down to your kind of most favorite class, I assume, which is industrial. So what's happening in that world?
Yeah, I would say so. I do a lot of work in industrial and multifamily. The interesting thing about industrial, my first love, and credit to my former Prologis colleagues too, is what I find just as a big macro backdrop to industrial is what percentage of there's two factors I really like. What percentage of all retail sales right now do you think are either brick and mortar versus e-commerce?
Oh wow. Oh geez. Well, oh geez. 20 brick and mortar, 80 online.
So what's interesting is you still have it's about flip of that.
Oh really?
Yeah, so you still have now if you it can be you can disaggregate a little bit more. If you take out car sales, which would be larger
Oh
dollar volume,
yeah.
closer to 60/40 brick and mortar versus the e-commerce. But then when you break it down generationally, so I'm in my mid 40s, and you even look at a younger demographic, that it starts to be skewed much more towards e-commerce, more in the 80% camp of all
Oh
sales.
okay. Okay. Yeah.
But when go ahead.
Yeah, no, that's fascinating. So you're saying the older demographic is still brick and mortar, and as we get younger, then it kind of flips to the other
Yeah,
side.
yeah.
Yeah.
So when
Okay.
I think about logistics space, a lot of industrial warehouse space is not always, but a lot of it is centered around the logistics and trade flows. There is going to I still think we're in the early innings of the disintermediation of retail, which is really the biggest beneficiary of that, in my opinion, is industrial real estate, and how that we're going to need a lot more warehouse industrial hubs for commerce and for the changing dynamic of how we consume and how we ship goods around. And then I think the other thing I find really fascinating about industrial is, again, taking my alma mater, Prologis, as an example, largest industrial REIT in the world. What percentage of all industrial assets do you think Prologis owns?
Oh, geez, I have no clue. Yeah.
So it's less than 5%.
Oh, wow. Even though they're the largest one in the world, they're still only 5%. Well, 5% is still gigantic, I'm sure.
It's huge. But one of my themes in real estate, one of the real opportunities I like is when things are very fragmented because it's not a winner take all environment. So, particularly, as a value investor, I'm not really playing with institutional quality assets. So I like, things like small bay industrial, multi-tenant industrial, not necessarily a Prologis, class A building that's 1 million square feet, that's an Amazon distribution hub in a major port like Long Beach. I'm not
Right.
playing in that category anymore. I'm looking for, the mom and pop owner or the, sub-institutional investment group that owns a class B industrial building in the path of progress where the
Uh,
rents are below market. There's opportunity to both operationally drive investment returns through operational wherewithal. And if you can buy that cheap enough and you can consolidate and aggregate a portfolio, I think that's a really interesting area to play in that we're still in the very early innings of.
okay, so let's skip over multifamily for a minute and jump to retail. So retail, in my view, has been incredibly hot right now. And actually that probably explains your numbers a little bit in that people are still going out and eating food and buying products from retailers.
Yeah, what I find fascinating about retail, I'm listing a strip mall right now in Milpitas with another broker, and it's 100% occupied. It's in a great asset. Milpitas is one of the most affluent and educated work areas in the country. But you look at what's working in retail and what's not working in retail, and for instance, there's a lot of retail business closures right now, and we've probably all read in the press, for certain kinds of retailers that are suffering. Let's call the big boxes of the world, the J.C. Penney's, the Searses, who are getting absolutely creamed by the internet. Whereas the things that are thriving are what you would call at least internet resistant or necessity based retail. So for retail, I think the bifurcation and the tale of two cities, where you have things that are grocery anchored experiential retail concepts, with your dentists, your lawyers, your small medical practices, where if I need to get my teeth cleaned, I can't go do that on the internet, right? I got to go do that in person. If I want to go out to eat with my family, yes, I can order food in, but if I want to have an experience, I go to a brick and mortar location. So I think, where you see a lot of potential in retail, I think where you'll see a lot of people thrive is either the really high end, the Simon Property Groups of the world, who have the Class A shopping malls that are destinations, like those will continue to thrive. I think also, places that are your Class B minus C neighborhood strip center that has everything from a couple local restaurants to a dry cleaners to a liquor store. Like that's still a great business model because people like convenience, and there's a lot of things you can do there. And I think the other thing that's interesting about retail is you think about back to supply and demand. I mean, a lot of the woes in retail shopping malls have already happened. They kind of went through the experience that office is going through right now, in an earlier cycle. So there hasn't been a ton of retail construction in the last, 7, 8 years. So there's really not the supply issue that office has.
Well, well, we could get specific here. Maybe are you familiar with the Hillsdale Mall at all?
Sure. Yeah, absolutely. I mean that, or what's going on with Valley Fair too. I mean, two good
Well,
examples of
yeah. Okay.
redevelopment. Yep.
Yeah. Okay. Yeah. So yeah, that's an interesting transition. They're gonna break that up. The fascinating part about Hillsdale, we had David Bohannon talk to us the other day, and he is putting in 2 million square feet of office space there. And I asked him, David, are you crazy? Why are you doing that? And he basically said, I mean, the answer was basically, if you build it, they will come. We have the transit center, we have the location, we're going to have the amenities. It's going to be a great location for office space. So anyway, I thought that was a very bullish approach to office space.
Yeah, and I'd also say too, and give the developer credit for this, not my keen insight, but I appreciate this form of development. I think the other concept that works really well is bigger mixed use projects or redevelopment projects where they're adding, retail is so much driven by the proximity of rooftops and consumer spending, and whether it be from a daytime population of commuters or households that are close by that want a destination. And if you are building, I think actually, taking a Bay Area example, look at Santana Row. I mean,
Yeah.
Santana Row is thriving because they have a true live, work, play environment. The New York area where I'm from, look at Hudson Yards. I mean,
Oh, yeah.
literally one of the greats of Related. What they've done there to be able to put a lot of, office employees, a lot of residents. They've really transformed the entire west side of New York, to their credit, which used to be entirely, industrial. So that, I mean, there's I think a repeatable, scalable blueprint with that, where, savvy developers with a long-term view, also very specific things too. I'm a soccer fan. You
Yeah.
look at what is going on down in Miami with, Messi, and the family behind
Right.
that is one of the biggest construction families in Miami, and they're anchoring a whole retail district around a stadium, and a stadium redevelopment project. And I think that also a very savvy play from using tax dollars and all sorts of tax efficient loopholes for capitalizing for their investors. But there's interesting ways you can create whole districts of live, work, play that are vibrant for brick and mortar retail.
All right. So now let's go to the famous multifamily world.
Yeah, I mean multifamily. So I'm involved with a fund out of this that's concentrating on southeastern multifamily investing.
Mm.
Our bias is towards again, not a political comment. I'm just following where the data drives, but we're mostly investing in states that are growing, both demographic wise, employment wise, population migration trends. And so, we're investing in different Florida markets, the Carolinas, Tennessee, Georgia. And, the long-term demographic trends really support the Maslow hierarchy of needs, of needing shelter. And I think, what's interesting about multifamily right now is twofold. One is, I'll say threefold. One is that you had a lot of silliness in the previous cycle where everyone and their cousin became a multifamily syndicator. And if there wasn't, outright, there's just a lot of bad real estate investing, to put it, charitably. Some of it was,
But are you talking pre 2007 or even
I,
after that?
I was, I think there's been a lot of, I try not to speak ill of our industry or, others, but there was just a lot of stupidity. There's really nothing else to say about
Okay,
that.
we'll leave it at that.
Yeah,
Yeah.
I mean, it was just,
Okay.
especially in this, I'm looking at all the Sun Belt markets, I mean, it's hilarious to me that like, Nevada and Arizona, it's like every cycle is just complete boom bust markets. I mean, people just go way over their skis, and it's like, what did you think was going to happen when you were building or buying at, sub treasury rates, and then, and you're also goal seeking your rent growth into something that made, no sense for exponential growth, and like, oops, shocking, it didn't work out. And you had no,
Oh, oops.
yeah, and you had no interest rate caps on your debt. I mean, I could go on. But so I think what's interesting in multifamily right now is, one, there's a lot of carnage. There's a lot of I think a lot of the excess is being cleaned up. So if you're a strong operator that's really experienced and can differentiate yourself from what's going on in the larger asset class, I think can really stand out in a positive way. Second, that's interesting is because it's tangentially related to for sale housing, although it's not like Fannie, or it's not completely subsidized mortgage market. You do have a cheaper availability of debt with agency debt in multifamily,
Mm.
which I still is I think a key component to making the math work. And then, finally, I think, you have a really interesting dynamic around, housing right now where you have, you know, housing has become very unaffordable on the for sale side. You have a large segment of the population that is either, necessity based renters or renters by choice. And you have, if you're buying fundamentally sound properties with good cash flow, there's, a really interesting trade, I think, for, playing front running a lot of the population shift and growth long term for, certain cities and certain demographics. And I think places like Nashville, I think places like Florida, well run states that have good, pragmatic, pro business, pro regulatory environment leadership. I think there's long tail macro tailwinds to treat multifamily really as a fixed income alternative for a lot of investors.
So I haven't heard you mention Texas yet. I'm curious about that.
Texas, I mean, I love Texas. I think, and shout out to all my Texas friends. What I love about Texas compared to the Bay Area is like, Texas actually allows supply to happen, right? So you have, I mean, it's hilarious. Like I'm active in Austin and Houston in multifamily. Both Austin and Houston, Dallas, Fort Worth too. You actually have had for almost two plus years now double digit declines in rents. And why? Like this isn't rocket science. It's because they had a bunch of supply.
Oh,
You had all this supply being delivered. So you can actually buy stuff. My theory of the case is that you're buying stuff. Maybe not quite bottom ticking it, but you're close to near the bottom of where rents are declining. And you look at there's no new supply. I mean, the supply spigot has been cut off because there's no because you no longer have the drivers for demand. But long
right.
term, do you believe that Texas is going to be a good place to do business? That's going to be a good place to attract population flows? Yes, I think like in 2-3 years you can have NOI surge. Like that's an interesting setup there. I like that.
Well, but yeah, I've heard over and over during these podcasts that Florida, Carolinas, and Tennessee, Georgia. I think, did you say Georgia? I think you said
Yeah,
Georgia. Yeah,
Atlanta.
yeah. So, oh, Atlanta. Okay. So anyway, yeah, all great markets. I'm curious though. I mean, I see maybe Cleveland and some of those other cities up north as being potential, but I never hear them.
I think the interesting thing, and in fairness, that's not. I know people who operate in those markets who I happily refer you to. I think we could speak more fluently about them. But what I like about the Midwest, and there is, again, not a political comment, but if the desire of policymakers is to have a reindustrialization of America and to have an onshoring of certain supply chains and trying to support various manufacturing, there are big catalysts happening in the Midwest because of the access to fresh water. So you look at I've done some work in the data center world too.
Uh,
There's most of a lot of the big data center projects. You look at what Intel is doing in Ohio. You look at what Tesla and XAI is doing in the Tennessee Valley Authority. Water is such a key component along with the electricity connectivity. And I think you have very, train in an era of, maybe emerging robotics, you have very, the Detroit comeback story has been fantastic, particularly what the founder of Quicken Loans has done, or Rocket Mortgage, Dan Gilbert, and some, actually Stephen Ross again, too, around related. You've been able to, take a lot of industrial workforce talent and retool and reimagine some of these cities. And, Chicago has its challenges from political leadership perspective and tax policy. But I think, you look at Midwest rents. I mean, some of the Midwest multifamily rents are some of the most stable and best in the country from a growth perspective. And I think, it's not quite as boom bust. It's more steady Eddie. But I think I definitely see the appeal of certain investors being focused on secondary and tertiary markets in the Midwestern states that are well run.
So let's jump back for a minute to industrial. I'm just curious, how much is Amazon driving the whole industrial world at this point? A little or a lot?
Yeah, Amazon's interesting. I think this is true of, some of the other mega retailers too. I'd put Walmart in this camp as well.
Right. Okay.
They've experimented kind of with a dual approach to their real estate strategy, where they've both been a very large lessee and tenant for some of the larger industrial operators like Prologis. But they've also done some, vertical integration of their own supply chain in their own warehouses. And, they've just similar to what I think there's a good parallel to what the cloud companies have done with their own data centers, where, they're, I think, experimenting to a certain extent of, maybe it's not their primary focus. Amazon is not in the real estate business. They're an e-commerce logistics retailer, and similar with, the Google or Apple or whomever, all these FAANG companies, they're not necessarily in a real estate business either, but does it make sense for them to at sometimes own their own real estate in certain markets, have that vertical integration of there's some very talented people on the corporate side at those companies in real estate, thinking about their real estate solutions, whether it's negotiating leases or doing site planning to be co-located near their customers. And I think, Amazon, particularly with their acquisition of Whole Foods, that last mile type delivery situation where they can have distribution centers near, like if I go walk into my Whole Foods close by and I don't, I got something for my children that's the wrong size, I can very easily return it there at a Whole Foods, go grocery shopping, and that can all be then sent back to a warehouse that's maybe 50 miles away at cheaper real estate. So I think they're definitely thought leaders. I think they're also they're driving the real institutional side for these mega distribution centers around key metro markets, and that's very different than what's happening perhaps in the mom and pop owner user manufacturer or small bay industrial properties that I think where there's perhaps more opportunity to drive alpha.
Well, Amazon has a big data use also.
Totally. Yeah, and I think what's fascinating about the data center thing is, again, no one's going to accuse me of being in my household, including my 9-year-olds, of being a technical expert for technology. But I do think that I want to be in the picks and shovels business for something like the data center boom and for what's going on with the AI boom, because I do think there's some truth to that. I mean, will there be too much capex spending? Will it go overboard? I wouldn't, it's possible. I don't have a strong opinion on that, or I think, from everyone I talk to are experts in that area. It seems that we're still in the early stages of it. And I've certainly seen the benefit of using some of these tools in my daily workflow. And I think that's true for friends of mine across different industries. But I think, data centers are really a derivative of industrial real estate. A lot of them are really very much smart warehouses. And a lot of the folks that are running this at the highest level, whether it's the Digital Realty Trust of the world or Equinix, they're industrial real estate people who are putting themselves in the center of the gold rush for the picks and shovels and saying we're going to figure out a way to get XYZ cloud provider or hyperscaler the location they need that's near both electricity, the water, and the population or business centers that need this asset.
Yeah. So, oh my. Well, I think we could probably go on for another couple days, but let's pause for a moment and just have some fun. What's your favorite food?
Oh boy, I'm a big Italian guy, so I have to say, although it's not necessarily great for my health, I love carbs, so I have to say pasta. I really enjoy, my father or late grandparents' lasagna. That's got to be a household favorite.
Oh yeah. Wow. What was there was it what was special about their lasagna? I'm curious.
The Italian words for grandparents is nonna for grandmother and nonno for grandfather. And my late paternal grandparents they immigrated from Italy to Toronto, Canada, and they had a traditional Italian household where you had your basically your presentation kitchen was upstairs, but you did all the cooking in the basement.
Oh,
So I have very fond memories of my sister and I learning how to make pasta from scratch with them, and it's just all the things that make, regardless of your culture or background, that as someone who loves food and loves learning about different cultures through food, if you use fresh ingredients, and I think take a passion for your craft. Cooking for me is my favorite creative outlet, and I think that's it's always been a great way to spend time with family and friends and to learn about other cultures too. And also, I mean, again, I'd much rather eat more than or much rather work out more than eat less. So that's how
Well, then I won't tell you about the 90-20 rule, what is it, 90-10 rule, that it's 90% input and 10% exercise. But anyway, we'll
I'm not
avoid
perfect.
that
I'm not perfect, Bruce.
conversation.
Yeah. Yeah.
Well, let's finish there. Julian, where could people get a hold of you?
Sure, absolutely. I'm Lawson Point Capital Advisors. You can go to lawsonpoint.com. My email contact information is on there, or it's my first last name at gmail.com, julian.scurci@gmail.com. I can also be found on LinkedIn. I welcome a chance to connect with anyone to help with their real estate investment needs.
Well, you are the expert, I think, for sure. So please get a hold of Julian if you need some interesting information about the market and value and all those good things. So
Thank you, Bruce. I really appreciate the time.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.